Wondering why investing in the stock market is so important? The age-old question of why you should invest your money in the stock market is addressed in this video. Stay tuned till the end. Over the years, the stock market has created immense wealth. The S&P 500, which includes 500 of the largest publicly traded firms in the United States, has averaged an annual return of 8% to 12%. Just $10,000 invested in the stock market 50 years ago would have risen to more than $380,000 today if it had grown at that pace. However, keep in mind that the stock market does not rise every year. 3 out of every 10 years, the S&P 500 drops. Some of those drops can be very painful, and that degree of uncertainty is not suitable for all. Stocks, on the other hand, have the ability to generate far higher long-term returns than other investment options if you can control your apprehension. What are the advantages of portfolio investing? Investing in stocks has many advantages. There are 7 major ones. The possibility of earning higher returns than bank CDs, gold, and government bonds. The opportunity to own a small portion of a business whose goods or services you admire. Stocks are more liquid than other investments, such as real estate, because they are easier to buy and sell. The opportunity to protect your wealth from inflation, as returns often outperform inflation expectations. Dividends provide a daily source of passive income. Remember, they say to have at least 7 sources of income. The opportunity to diversify a portfolio by investing in a number of industries. The opportunity to begin with a small project. Investors may start buying stocks with a small amount of money thanks to 0 fees and the opportunity to purchase fractional shares with several online brokers. Is there a reason why you shouldn't invest in stocks? Stocks have some disadvantages, the most important of which is uncertainty. The stock market drops 10% from its peak every 11 months on average, 20% of every 4 years, and more than 30% at least once every decade. Stock investing isn't for everybody. Consider the following reasons why you shouldn't invest in stocks. You can't bear the risk of a loss of more than 10% on your investment. You'll need the money in the next 3 to 5 years to put down on a house or make another big expected purchase. You're retired or on the verge of retiring and prefer a steady income stream to the capital appreciation opportunity of stocks. Aside from worries about uncertainty, there are other reasons to avoid stocks. You have a lot of debt with a high interest rate, such as credit card debt. Paying off debt will also generate better returns than investing in stocks. You don't have enough money set aside for an emergency. Having enough cash on hand to cover an unexpected cost will help you stop having to use your credit card. You don't have the time or inclination to conduct stock analysis. Why should you begin investing right away? It's impossible to predict the stock market's movement, but amidst the unpredictability, the benefits of investing in stocks remains unchanged. What has changed, or needs to change, is the public's perception of the stock market and its associated risks. In addition to investing some of your available cash in a savings account, consider the reasons why stocks continue to be a viable investment and why you should invest in the stock market. While there are some good reasons to avoid buying stocks, for most people, the upside opportunity outweighs the risk. As a result, even though the market is at an all-time high, investing in stocks is almost always a smart idea. According to studies, an investor's time in the market is more critical than timing the market. Holding off on buying stocks until the right time can be expensive, as a large portion of gains are made over a short period of time. Stocks, on the other hand, typically rebound from corrections, fall off more than 10% in a matter of months. As a result, the longer an investor is in the market, the less likely he or she is to lose money. Financial advisors suggest to leave in at least 10 years. You don't have to be a genius. A seasoned investor might have an advantage over you as you're getting started, but you don't have to be a math whiz, wealthy, or another Warren Buffett to invest in the stock market. Compared to investing in a franchise or creating your own business from the ground up, the requirements for investing in the stock market are modest. Pick stocks that are issued by companies you know in industries you're interested in. This interest helps motivate you to stay informed about your investments. For most people, now is the perfect time to invest in stocks. Many with money they won't use for a few years should consider investing in stocks to maximize their profits. The return is better than letting it sit in your savings account. Waiting to spend the money is more likely to harm an investor's return than benefit them, which is why the best time to buy stock in a great business is almost always right now. Stocks can be an excellent addition to any investment portfolio. Investing in various companies' stocks will help you develop your savings, protect your capital from inflation and taxes, and increase your investment income. When it comes to investing in the stock market, it's important to understand that there are risks. Investing in the stock market is a great way to make more passive income, and the best part is, you put the money in and leave it alone for a long period of time. As Joey Tribbiani says in Friends, forget about it. If you found this video helpful, please make sure to like, comment, and subscribe to help us continue to make more videos and help you grow. Glad you're investing in your financial health. See you in the next video.